Good afternoon and welcome to RiskScout's monthly webinar. RiskScout is committed to providing insightful, thought-provoking content to bankers interested in starting and growing new business lines at their financial institutions. We provide a mix of personal and professional development to give you the tools you need to be successful. My name is Marnie Keller and I'll serve as your moderator today. Joining me on today's webinar is Kristen Parker, Director of Compliance at RiskScout, and Dina Summers, speaker with Bankers Hub and longtime regulatory compliance attorney. Their combined expertise in the area of emerging markets should make for a worthwhile webinar. This month's webinar is entitled Treasury Management Best Practices, and it's designed to help you leverage non-traditional programs to increase non-interest income and deposits. Following the webinar, all registrants will receive a link to the recording via email. Our presenters will leave some time towards the end of the hour for you to pose questions. If you have a question you'd like to ask, please put it in the chat box in the lower right-hand corner of the screen. I think that takes care of our housekeeping items, so now I'll turn it over to Kristen and Dina. Good afternoon, ladies.
Good afternoon, Marnie. Thank you for that. Hi, everybody. We're excited to be here with you today. My name is Kristen Parker. I direct the compliance efforts here at RiskScout. Just to give you a little bit of background, I've been in banking my whole professional career, which is about 20 years, with a focus on BSA AML compliance. But I have played many roles in banking, all the way from teller to working in various departments, but found my niche here in higher risk banking. And so I'm excited to be here with you today. And I'm excited to be here with Dina because I have quite a bit of alphabet soup after my name in regards to certification. And one of those certifications, Dina, I believe you taught. Is that right?
Yes, and thank you, Kristen, for that introduction. And I'm also happy to be here and appreciate everyone joining us today. I've also been in compliance. My area has been regulatory compliance as attorney, in-house counsel, chief compliance officer, outside consultant for most of my 25 plus years in practice. And my focus has always been in higher risk areas, fintech, BSA, AML compliance, payment processors, digital cryptocurrency, and more recently CRBs, cannabis-related businesses. So I work with financial institutions to ensure regulatory compliance and primarily how to operationalize these compliance requirements into our day-to-day programs. So also I'm happy to be presenting today with you, Kristen.
Good. All right. Well, I vote that we just go ahead and dive on in here. I thought we would start with going through our agenda here. Our agenda, you know, it's flexible in nature, but the general topics of what we'll be speaking about today is defining what Treasury Management really is and their role in helping achieve financial institutions' strategic goals. We're going to review Treasury Management best practices for breaking down silos to better work with other key departments and internal stakeholders. We're going to address adapting traditional workflows to incorporate unique needs of higher risk business customers that trigger additional BSA AML compliance due to regulatory requirements. And then we're going to discuss AML compliance best practices to limit exposures to bad actors. So let's just dive right into really what Treasury Management is. We're going to talk through this section about, you know, what is it? You know, who are really the stakeholders in Treasury Management? And what is the whole business line objective for Treasury Management? You know, when I was in multiple banks working, it was always Treasury Management looked, you know, maybe slightly different from institution to institution, but they overall had the same objective. So to really define what Treasury Management is, it's really a relationship management arm of a financial institution that either manually or through a management system aims to optimize a company's liquidity while also mitigating its financial, operational, and reputational risks. So when I think about this, I remember again that treasury management may look slightly different from financial institution to financial institution, but all of their roles generally have the same objective. And when I think about that objective and speaking with, lots of treasury management contacts that I have, I kind of went through and quizzed them all and kind of surveyed them all just to see what kind of collective answer I'd get about what they felt like their purpose really was and how they kind of viewed their thought of how they are part of the life cycle of banking, right? So it boiled down to the general answer being they typically operate, or they feel that they do, and I would say this is true, typically operate as an extension of the business development team by offering services that optimize customer experience and business operations. I like to think of it as tying together sales, lending, services. So they're there to, they're an extension of business development, right? They're extension of, they kind of live in this quasi strange space at some institutions. Some of them are on the forefront of other institutions, but generally their role is bringing more value to that client's relationship, right? Making that client more sticky, if you will. Dana, you got anything to add in that respect?
Well, and I agree, and I appreciate the definition because in my experience, I've always been, focused on the regulatory side, and I have gone in, performed audits from community banks to SIFI banks, and I think also I was impressed to see, and it may be that the bank has a particular or very strong culture of compliance, but what I've seen is it's always been focus on relationship management and business development. But the big difference I see from institution to institution is the level of involvement or the extent of involvement from the treasury management team in compliance matters, compliance processes. I've been to a few in the higher risk areas. I've seen in my experience in speaking with treasury management, a few events I've attended both this year and last year. For higher risk entities, they're much more involved, at least in understanding the risks, as opposed to just simply looking to bank more and more of that type of customer. But I do agree, it's been primarily a focus on relationship building and business development.
Yeah. Yeah, so when we think about treasury management, we really want to understand where their goals come from. So the board, if you look at the hierarchy of how banking typically works, the board is always responsible for setting organizational goals. So they're the ones that are looking at the long-term and short-term objectives, and they are laying out what they believe should happen for that year, 18 months, or even the short term for that institution to be successful. From there, execution of those goals and strategies are designed by senior management to help achieve those organizational goals set by the board of directors. So what that may be looking like, it can look like a bunch of different things based on the institution you're at. They may say, okay, we know that our goal is from the board that we want, to bring in X amount of deposits over the years. So then the next level down would be understanding, okay, what does that look like? What is the number of deposits that we need to grow by, and how is it achievable based on how we're operating as an institution right now, and what do we need to maybe execute to achieve those additional numbers that are laid out, right? And then from there, we're going to have each line of business from those objectives and strategies that were laid out, build out what their metrics need to look like to support the execution of those strategic strategies. So it can look different from each line of business. And in regards to treasury management, every line of business setting their own is going to look different from theirs, because their performance metrics in treasury management typically look different from business development and are focused more on creating again, those sticky relationships. When I was out interviewing a bunch of different treasury management professionals, what ended up coming out a lot was, at the end of the day, some of the biggest challenges is creating new business to come over. Because typically, and if we're just all going to be honest with ourselves, we don't just go bouncing around to different banks. It's a pain to switch banks. You got to switch all your payments, all your direct deposits, so on and so forth. Customers don't leave unless they are dissatisfied, right? And that can make it challenging because it's different than what it looks like maybe in the loan world, where you have the option with different terms, you have the option of offering different rates that may incentivize those people, those customers or individuals or businesses to move their relationship. It's different with treasury management because you don't necessarily have that flexibility because you're not offering those services. So your goals may look different and include maybe a certain number of merchant service relationships, cash management services, anything to make that relationship more in depth, that it's less likely they're going to leave because frankly, it's going to be more of a pain for them to leave. Again, because it's just because people don't want to move banks for the sake of moving banks. Some ways they may be dissatisfied with their bank that they may move may include that their fees are too high, right, at their institution. Well, you could argue that they could go back to their institution, say they're going to leave, that institution says, why? Well, my fees are too high, and then they just adjust their fee structure and they end up staying. So that's not typically, a very good reason that people will want to leave, because they can work it out with their institution. Maybe it's that they don't have the luxury of maybe a certain line of business that they're operating, that institution doesn't allow them to bank there. That could be very well the reason somebody leaves. If you're offering competitive services to lines of businesses that just don't see a lot of opportunity to bank places. Dina?
I think it'll be interesting to see, and I completely agree with you on that. It is very difficult to move from bank to bank. I think it'll be interesting to see how this plays out in the coming years, whether we have some form of open banking, like our European counterpart. And so open banking, I think there's a possibility to move to a system where the process for moving from one bank to the other is easier. And I like the example you gave about the fees, because if anyone on this call reviewed the remarks by the CFPB when we were talking about overdraft fees and their coordinated effort with other prudential regulators to crack down on overdraft fees, that was one of the points in the director's comments. People are sometimes stuck with the bank because it is so challenging to move to another bank. So I think it's a sort of a double-edged sword. It is hard to bring customers over, but by the same token, if we move more towards this open banking system where it's easier to move from a bank to bank, it'll also put more pressure on your bank to have better processes, more competitive product offerings and so forth. So I think that's something that we might see change in the coming years.
Yeah, which, I mean, it's interesting that you end on that because it's a good segue, and it really is more than ever, there's a need to be more creative in your offerings and your ability to compete with other financial institutions, but not just them, but your non-traditional banks, your fintechs and stuff, that they just make it easier to bank than traditional banks do. And so in order to survive, frankly, it's time to think outside the box in that manner.
Yeah, completely agree.
So when we're thinking outside of the box, we're talking about, really being creative in what you offer. And one way of doing that, and a lot more institutions are taking advantage of, is exploring non-traditional markets to offer competitive banking services that create sticky customers. So what I mean by that is and I guess really my question for you people listening is, what are you doing to stand out and offer services that make you different from every other bank? Because if you're not, and it's just your customer service that is keeping you afloat, it's time to start thinking about different creative ways to stand out. And one way that's pretty achievable pretty quickly is exploring non-traditional markets to offer, a type of competitive offering. When I think of non-traditional markets, that's markets that either are new or seasoned industries that are underbanked due to known or perceived regulatory burdens for banking these industries. So when we think about this, we think about money services businesses, ATMs, independently owned ATMs, crypto, cannabis, hemp, other types of non-bank financial institutions. Non-traditional markets are seasoned and new. The reason a lot of them aren't banked is because of the known or perceived industry risks, along with regulatory compliance burdens. That's what often leaves these guys underbanked. It's because people think it's probably too hard. Maybe it is out of their risk appetite, but a lot of times people say things like, that's out of our risk appetite. And then you say, okay, how did you determine it was outside your risk appetite? And they're just like, just sounds risky. It's so frustrating in that sense, because it's like, no, if we want to be realistic about this, you probably already are banking these people. Whether you want to acknowledge it or not, you're banking these people, and you're probably just accidentally turning a blind eye to it, because these guys are banking somewhere a lot of times, and just under the guise of another type of business. So either A, they're not charged the fees, or B, they knew they couldn't bank somewhere if they really fessed up to what they were doing. And if we really want to be serving our purpose as a financial institution that's in a community, we should be really looking at the businesses that are in our communities, even the ones that are perceived to be higher risk, and really understanding what is the purpose of this business here, and really try to understand what the true risks are, so that really truly do these industry types fit in my risk appetite, or do they not?
Yeah, and just to touch on that, I hear that a lot too, with the blanket response, not within our risk tolerance, but that's an evolving baseline. At least the bank should be performing an ongoing risk assessment to identify areas of risk, either through exposure in your BSA program that were previously unidentified, or for evaluating or reassessing areas or potential products or services where you're willing to take on more risk. So the risk appetite isn't the proverbial, policy or statement that's filed away and not looked at again. It should be an ongoing assessment that your bank is performing.
Right. And what I find sometimes too, speaking with institutions, not sometimes, but actually a lot of times, is they may say, okay, well, we would entertain this, but one of the biggest reasons we don't is that traditional operating systems at banks are not designed to bank these industries in a scalable or sustainable way. Most programs that are catering to these businesses that take a little bit more hand holding are trying to do it manually, which is just not sustainable. And I'm not just saying that for the sake of saying it. I ran a BSA program at an institution that we banked every single one of these guys that's listed on these slides, and tried to do it manually. And while we learned that we could in a way, it was not scalable, and it certainly wasn't sustainable. Because when you open your doors to these industries, it's very much so that you're going to get everybody who finds out that you're banking it applying and they may not truly be part of who you want to bank in that industry, and that's okay. But you trying to do it manually is hard, and that's where a lot of institutions run up against, is that they're saying, well, my traditional onboarding system won't support this. My traditional transaction monitoring system won't allow me to monitor these guys the way that I feel like I should be monitoring. So they get turned off like that and just are like, okay, because of that, we're not going to bank it. When literally there's options out there for you to explore for being able to bank these guys
Mm-hmm.
successfully. What I find is that most of these businesses are just really grossly misunderstood, that they're not really nefarious businesses, that, you'll have some bad actors in there like you do with every other industry. Even your supposedly non-high risk industries, you're going to have bad actors in there. But if you don't let the good actors in, how are you ever going to tell, right?
Yeah, and when I've walked in recent years, actually, I would go back so far as to say 2014, and this was a bigger bank. It definitely wasn't a community bank, and they were still very paper-based and performing reviews manually. I don't see how those institutions are going to survive, especially in the current climate with, dynamic, ever increasing, ever evolving risk culture that we're in. And given FinCEN's directive, and one of those that was published around the same time as the AML Act of 2021, and that is we need to be, and institutions should be looking at more innovative technologies to manage risk, and BSA being one of the biggest ones. And you're right. I think it's just a linear way of thinking that limits banks from taking the initiative to bank these other perceived higher risk entities.
Right. And then, I think what's important to note is that the regulatory expectations for banking these industries is higher because of the increased risks of these businesses, either wittingly or unwittingly being involved in illicit activity. It doesn't mean, I think we need to clarify that every business involved in these industries presents elevated risks, because that's simply not true. When you think about it, a good example is you have the THC cannabis industry, also known as the marijuana industry, right? Usually those are typically broken out into tiers. Tier 1 being those are your plant touching businesses, and tier 2 being just a supplier to the industry. Maybe they're making the packages that these products are being put into. Maybe they're making the tags, so on and so forth, for tracking. The risks that these industries, sectors, the sectors within the cannabis industry present are vastly different. Those plant touching businesses present a completely different risk than those who are just supplying the packaging to that business, who aren't touching the plant at all. So it's different varying risks and different regulatory obligations based on parts of the sectors that you're banking. So it's important to not put a blanket statement risk on an entire industry without reviewing the sectors underneath the industry header to say, okay, well, maybe I don't want to bank plant touching marijuana related businesses, but I'd be okay with banking the people who made the packages for them, because they're quite profitable in and of itself, and the risks presented differently than those who are touching the plant and require me to file reoccurring SARs. So just some food for thought there.
Yeah, I'm so glad that you said that. Actually, if we can pause that for a second, because I think that's a big misunderstanding, and it may have been an older regulatory guidance that certain industries are high risk or inherently high risk. And what we'll talk to when we get to this later in the presentation, and that's identifying risk. There's an inherent risk, mitigating factors, and then you have your residual risk. And you're right, not everything within the sector carries the same risk. And so I think that's another, again, linear way of thinking, that all of these categories that you've listed here on the slide are just inherently higher risk, And so banks are hesitant or trepidatious to begin to adopt any program to bank these customers, where I think that's flawed thinking. And more than that, the FFIEC guidance examination guide was updated in several parts last year, and they specifically amended the language from being higher risk or to may pose a higher risk, just to clarify that point.
Yeah. Yeah, and fun fact there, Dean, I don't know if you knew this or not, but we at RiskScout had participated in the FFIEC manual update for the independently owned ATMs, and we're able to help rewrite some of that to clarify, just based on the experience we had working in those industries.
Well, no, I did not know that. That was a fantastic find.
Yeah.
But yeah, I'm glad that you brought that point up, because I think that's one of the biggest misnomers in banking these customers.
Absolutely. Absolutely. So always thinking about, saying when we talk about these in industry sectors, and we really want to drill down to what's in it for me, right? We want to know what, if these truly bring elevated risks in some manner, or I'm going to have to maybe beef up some staffing in some areas, maybe compliance via AML, because I need additional bodies to help me run this. Well, what's in it for me? Why would I even want to do that? What on this slide, we have just a small snapshot to show you a glimpse of the opportunities that can occur when you're embracing these non-traditional markets. We have markets here that are just on the trajectory of growth only, no downfall, and they're only going to become more popular. Some industries may shake itself out. We're seeing that a little bit with hemp, but not seeing any decrease in the growth. We're still seeing an increase. It's just, the market is just fascinating in this space, that we have some of the most underbanked industries, yet they're some of the fastest growing ones. So as a follow-up, just so you guys know, as a follow-up to this webinar, you'll have the opportunity to download documents highlighting some of these non-traditional market opportunities. And on those documents, it's, tells you about the market opportunity on the front, and on the back side, it's going to tell you all the compliance considerations you should have for helping mitigate the risks that are perceived risks or known risks that are involved in these industries. So you can kind of get a holistic view of, these are the opportunities, but these are also the things I should consider from a regulatory burden perspective. Really, what I like to think about this is, there are several plays here. There's the ability to drive fee income. There's the opportunity to grow deposits significantly. There's lending opportunities. There's even SBA lending included for hemp and CBD. And then the cross-sell opportunities to create a sticky customer are really incredible. We have a couple of case studies of institutions that are in this market that, you can see that their cross-sell ratio was through the roof, because these people, one, they're loyal. If they can find somebody to bank them, they're going to stay. So long as, your bank is offering them the services that they need at a, reasonable fee income, or a fee to them, they're going to stay, because they're just thankful they have some way to grow their business, right?
I think also with growth opportunities, as we talk about risk assessment, usually in consideration of onboarding particular customer or customer segment, or risk assessment for the bank or credit union from an enterprise level. But one other area to consider is, and as you pointed out, we'll look at the CRB, the cannabis-related business market, as an example. There are different participants in there. We usually think of just the retailer, the dispensaries. But if you're an agricultural bank, for example, it may be a natural fit to bank the growers in that particular market segment, which carries a different risk altogether than the dispensaries. In addition to SBA programs, there are also hemp hemp loan programs through the Department of Agriculture that are subsidized and available for banks as well. So and we're just talking about a sliver of opportunity in this one particular market. The opportunities are endless, and the cannabis, again, going back to that industry, it's arguably the fastest growing industry in the world. And I've been, jumping up and down for several years to get the community banks and credit unions to consider and seriously consider banking these customers, because the opportunity is incredible. The cash deposit, as you mentioned, and starting with banking relationship, you may move to lending relationships. And you're right, once they're banked, and not just the cannabis industry, it's the same for payment processors and those that were really historically frowned upon in the banking industry for years, being money service businesses, MSBs. Once they get a bank, they want to stay. They're going to remain with that bank. They're going to be loyal with that bank. There's so many areas of opportunity to consider here.
So I think it's important as we say, oh, there's all these opportunities, you should go out and consider these things. We need to really understand what's the best practice for proposing a new non-traditional banking program. And if we really want to break it down here, it's working with key stakeholders and breaking down the silos in order to make a succinct effort at a successful non-traditional banking program. It can't just be Treasury Management that says, I want to do this, you spearhead it, and then everything else will fall in line. There's multiple parties that are going to be involved in the rollout of this cross-departmental, and it's going to be, that effort is probably going to be an ongoing effort. Once you have your program shored up and set up and played, while most of it's on cruise control based on how you've chosen to do it either manually or through a third party to help manage it, either way, you're still going to have that intercommunication between outside of your department that's going to be needed in order for it to be successful. So when we talk about best practices for breaking down silos, I can tell you from experience, when I was building these programs, after I was, we had gone through the motions of a risk assessment and board buy-in, that we were gonna, collectively go into this, we set up task force to help this be successful to begin with, and then it morphed from there. I had a very good working relationship with the departments at my institutions, and I made an effort to always explain the why behind I was asking for something, or I made it my best practice to not necessarily say, no, we won't do that, or more so from a BSA AML compliance perspective of we can if, right? So not a no. So one of the best practices you can take away from here is don't be scared to work with other lines of businesses that are traditionally outside of your normal day-to-day operations. So for Treasury Management people, that includes BSA AML compliance, typically known as the no department at an institution. If you really work at helping them understand why, from a strategic goals perspective, you want to be doing this, you're going to have a lot better success rate at getting their buy-in and understanding of the why, so that the pathway to achieving a successful and scalable program is more likely than if you just say, we're doing this, figure it out, right? The only way a non-traditional banking program can be successful is with the cooperation and support of BSA AML compliance. And that is because with all of these industries we're talking about, they are going to have to do some extra legwork. There are things that they're going to have to check in with the clients about on a reoccurring basis. They're going to have to go and on a reoccurring schedule, look back at all of the transactions they've done to see if anything looks funky, making sure that the activity in any account is commensurate with the stated nature of the business. There's some legwork that people just don't understand happens really on a daily basis in BSA and AML compliance, but is even more so a burden on that group if they don't have the right tools in their pocket to do it, to streamline those processes. So strategic planning should include cross-departmental communication on ideas for reaching key metrics so that all parties' objectives and regulatory requirements are considered and addressed at the time of the program build. And then as those expectations change, as industries mature, as your banking program matures, your approach to your program may also mature, and it probably should mature because not everything looks the same year over year necessarily. So you should be collectively taking an assessment on your program throughout the life of it to say collectively, where do we see the pain points? What can we do to help streamline this? Are we banking the people we really want to be banking here? But again, it boils down to understanding the why behind others' ideas and concerns, which helps streamline communication and understanding between departments. Does that make sense?
Yeah, and I think this ties in well with what we're talking about on the next slide. And I think also what you're saying is align yourself with, we might refer to them as sponsors in each of these departments, because if you have, an enterprise approach is going to be required, and to have it successful, or at least if this is what you're pitching to the board or to upper management, rather than just starting out with a tabula rasa, with a blank slate, it helps to, tremendously, it improves your chances of success by having sponsors in these other departments, working with other departments. And you're right, BSA, AML being probably the most critical in this strategic plan.
So when we talk about communication between departments, the simplest thing you can do is have reoccurring set standard meetings with those sponsors. And you need to set an agenda. In those agendas, you need to be talking, after initial goals and metrics are discussed, best practices for maintaining effective communication. It's always going to include discussing those performance metrics and any concerns parties may have about those metrics. Those metrics may be, oh, we want X number of businesses. Well, if that was the goal that was set, and you're just trying to check that box, it may be in garbage in, garbage out. You're not getting a lot of bang for your buck when it comes to the clients that you're banking. So you really all need to be on board of, these are the type of clients I want to meet. And it may be that your metrics are, you set out metrics that said, once we get to this number of customers, these are the next steps we need to take, because at this point I've maxed out what I can do manually. Now I need to invest in some type of software to streamline the onboarding process, the due diligence process, the ongoing compliance processes, that whole 9 yards there. So it's always, again, have an open line of communication with each other to address the immediate questions or concerns. So not just waiting till you have to sit down for this reoccurring meeting. It should also include making sure that you have the ability to have that support. Some of my, I actually had lunch with an old Treasury Management friend of mine last Friday who we ran and started one of the first hemp making programs after the Farm Bill passed in 2018. And we have a great relationship because we kept an open line of communication about any problems. And he understood the why behind the processes we had set up, to that they were there to protect him and the institution against violating their own policies or procedures or regulatory requirements. So the better you are at setting up those relationships with those sponsors or those departments, to have that open line of communication that can occur for immediate one-off situations, the more successful your program is going to be, because you're being collectively on the same page about what your approach is to certain customers that are onboarding. When we talk about meeting treasury management goals, emerging markets offer a high volume of potential customers. Again, if you don't think you're already banking at least some of these emerging markets, you are more than likely wrong. I hate to tell you that, but it's true. These guys, again, will come in as under the guise of another type of business, or they may just not know better to disclose because the institution's not asking the right questions to uncover them. So I like to tell people, if you are not banking these industries, or you state you're not banking these industries, you have to prove that you're not banking these industries to your regulators. They're going to ask you, how are you say that you're not banking these? How do you know you're not? And sometimes it's easier to embrace these industries and bank them than it is to try to find a way to prove that you're not. Keep them out of the door. The last thing you want is your regulator as a banker to find a business that you thought was operating as maybe just perhaps a convenience store, and they actually are a money service business, and they're cashing loads and loads of checks. They're sending money all over to different countries, and you had no idea what was occurring right under your nose. You don't want that situation. There's multiple other examples of that. So if you really can take it back and do some soul searching here, maybe the question should be, how do you, if I'm already probably banking these people anyway, and it's probably easier just to bank them in the long run, if we really want to tell the truth, how do I convince the board and risk management team to let us take them on? And it really boils down to needing a strong business case as to why this is a good move for your financial institution, and that it is ultimately in line with the board's stated strategic goals. So some of the ways to achieve that is, consider utilizing an ROI calculator to prove your case. One of the ROI calculators, that you should consider using would include fee income revenue, right? How much fee, if that's your institution's goal to increase fee income revenue, that needs to be included on your return on investment calculator. It also needs to include deposit opportunities. Also needs to, show that you have considered what staffing needs or staffing and software needs that you will have to take on or consider when talking about bringing these type of businesses onto your institution. Deanna?
No, I think just to segue to what you're saying, if you can go to the next slide, because I want to cover, you're talking about identifying a particular risk, and actually, just to touch on, you said you may be accidentally banking these customers. One of the banks that I got to know, because they're one of the fewer ones several years ago that were actively banking a dispensary, and that was because they inadvertently banked the customer. And so they, for reasons unknown to me, they revised their policy, quickly developed up a program, which is not the way to do it, not the ideal way to do it. But that banking that one CRB customer is so successful, they grew the program, and they're now banking 13 cannabis-related businesses. But your BSA AML compliance program reflects or it should reflect the bank's risk profile as we've talked about, and certain customers, products, services, including emerging markets, may pose higher or specific money laundering risks, and then depending on the specific characteristics of that particular customer, the risks, as Kristen said earlier, the risks are not always the same. So you want to make sure you understand and evaluate the specific risks associated with doing business with a particular customer, emerging market that you're considering, and work with your BSA team to ensure that the goals and processes for evaluating and accepting these customers are aligned. The traditional method has always, or historically, was for each department to manage risk independently, focusing on those areas that pose the most risk to their specific operations. But the risk factors, and we know this now, the risk factors in one department affect the risk factors in one or more departments, which ultimately influence all risk factors. And that's why it's so important to break down the silos and collectively consider all the risks that are posed to the financial institution and their impact on the bank as a whole or the credit union as a whole. Mapping policies and procedures, this is a consultant tool. And I learned this later in my career, and I actually found it invaluable, and I still do this today. And that's mapping your policies, procedures, and processes across your bank or credit union, and including, so from onboarding or the first customer contact to termination of the customer. And you want to include both the front, middle, and back offices. So think of your front offices consistent of those client-facing roles, sales, trading, the middle office involving the personnel who directly support the front office, risk management, your compliance department or group, finance, accounting. And then your back office is generally almost exclusively operational. When you map your processes from the first customer contact to account closing, this will assist, again, including and identifying the person or persons or group involved, the technology that's involved, and the process or procedure. That helps to not just identify compliance gaps in technology, but also for areas where you need improvement or areas to just reduce bottlenecks, for example, so to improve your process flow and the banking workflow. So even though we're talking a lot about compliance, we've touched on customer satisfaction. In an increasingly competitive market, it's really crucial to deliver optimal customer experience. And so a lot of the issues that you'll be able to identify through your mapping process, you'll be able to identify through mapping a lot of those issues that impact the customer, and that's your bottlenecks. The time for your loan program, for example, from application to funding or closing, or even a decision. So your lending life cycle, risk management, compliance, all of those are normally riddled with bottlenecks, and so you want to map it out so that when you're are ready to present or share and work with the other team, you have a holistic approach, and you've already identified those areas where you're going to need improvement, where you'll need technology. As Kristen said, well, we only have traditional technology. Well, there may be, there's countless fintech or financial technologies that support banking particular customers or higher risk customers. So you want to also, again, map the process, because if there's a hiccup in any one department, then the whole system suffers. So you have to consider both the compliance requirements as well as the customer, and you want to optimize your customer experience. And so that's why also this interconnectedness we keep talking about, in developing your processes and procedures and managing risk. This interconnectedness and removing the silos and working together at this enterprise level is absolutely critical. Do you have anything you want to add to that, Kristen?
No, that was great.
So if we talking about compliance and risk management, we touched on this, but to really elaborate a little bit further, as you know, effective risk management requires the categorization of customers into risk categories, but you also need to assess the stratified nature of risk within each category. So the example we both used, cannabis-related businesses. Well, within that market, you have growers, you have processors, you have what's considered your tier 2 businesses, and those that are a consulting firm, for example. They're ancillary to the business, but a majority of their revenue is derived from cannabis-related business. Well, technically, those are still CRBs. Those are tier 2. So your compliance and risk management takes all of these things into consideration. You're not just looking at the segment as a whole. You're really looking at the stratified nature of risk within each category and specific to each particular customer. And then depending on the nature of risk, the controls that you have in place, and also the controls within that customer, that leaves you, of course, with your residual risk. And your due diligence, your ongoing monitoring are all going to be based on the specific risk that's identified by that customer.
Yeah.
So reporting, I saw it as we were flipping the sides. So just reporting is of course, I mean, that's required throughout the institution and every aspect with regard to compliance. But also monitoring your KRIs, your key risk indicators and risk categories. That's also going to ensure that new risks haven't arisen. So best practices for customer selection. Enhanced due diligence is required if the customer is deemed to pose a higher risk, specifically for money laundering. You're going to be required, or at least your BSA team is going to be required to monitor those customers more closely. And you're going to also, I need to back up, sorry. Once you've identified a customer as being higher risk, you're going to have typically two different due diligence requirements, your regular due diligence and your enhanced due diligence. But for these particular customers, if you're going to be banking CRBs, cannabis-related businesses, you're going to need to assess, evaluate, and update both your VDD or vendor due diligence and your EDD or enhanced due diligence program for these specific customers. They're going to include how you identify. So Kristen said you may be banking these customers, but you may not know that yet. So you have to have the proper and appropriate questions, whether you're banking these customers or not, to identify these higher risk customers and the relative risk factors specific to that particular industry. Your risk stratification, that's going to address how risk differs within each of the high risk categories. And then you want to assign a risk score to each customer relative to others in the same group. Your enhanced due diligence, again, this is building out workflows. You're going to have a template that's specific to these particular customers. And you're going to build a workflow that's going to designate or at least identify when your ongoing due diligence or your review is going to be required for this particular customer, be it every quarter, every 6 months. For normal VDD customers, it's generally about every 12 months, but you're going to adapt your existing framework to be able to effectively manage the risk for these particular customers. And it will look different for each line of business. Surveillance is the practice of applying really targeted analytics, and this is where your technology comes into play. Doing this manually, I think there's only been one, there have been 2 enforcement actions related to banks that were banking CRBs. Only one of them, and that was for failing to have an effective BSA program to monitor this particular customer segment. Much of the work was being done manually, and this is an area where I don't see how it can be done effectively. And Kristen, you may have better insight working with the bank to respond to this. But this is where your analytics, your really advanced analytics that are needed for me to effectively and adequately monitor these customers become so critical. And that's where surveillance, the surveillance should be ongoing on a daily basis, tracking transactions, monitoring accounts so that you're able to identify the risk as it's occurring, not when you're reviewing it or the team's reviewing it 3 months later. And that was the case for one of those enforcement actions. They weren't timely identifying these risks.
Yeah, and I would just reiterate and say that when you build one of these programs, you will find that it can turn into a field of dreams scenario where word will get out organically throughout the industry in a program with real investment into it that's doing marketing. You're going to see it. If you build it, they will come. And so what you want to do is ensure that you have the right filtering in place to make sure that you're actually looking at applicants that would fit your risk appetite. You know, that's a huge time waster if you're just letting everybody and their brother apply, and then you're having to do due diligence on people that or businesses that just you would have never considered banking. And the other consideration is when you have one of these programs, you can, you know, if you have with the right technology, you can have the ability to virtualize your branch. So you can have your commercial account opening online, which allows for prospects to seek you out instead of the other way around, which is a great way to quickly grow a line of business.
Mm-hmm.
We do know that with a lot of these industries that they do end up being cash intensive, some more than others. As a result, we want to be cognizant that we need to be mindful of what that means for the institution. So some non-traditional markets include cash intensive businesses. So you'll need to understand the cash needs and demands of these businesses prior to onboarding. And your solutioning needs to occur for how their cash needs need to be handled prior, you know, during your program build and through your conversations with these clients as well. Anything to add?
Also, go ahead. I'm just going to add about the cost factor. One of the questions that often I get is how much. So for again, going back to CRBs, what are banks charging, and are they charging specifically? Do they have a one charge for cash management, or is there just the ongoing account fee? In my experience of what I know, for the CRBs, they range from $1,500 to $2,500, and that includes all of the a la carte fees. But there are banks that now more recently, and probably because it's more competitive, are starting to charge for the cash management fee line item Treasury management fees are all separated and pass through to the customer in addition to that monthly account fee. And monthly account fee is primarily for the additional compliance costs for banking that customer.
Sure. And then just for sake of time, I know we're running right up on 5 and there might be a couple questions, but you know, there are ways to manage this cash successfully, regardless of whatever avenue that you pick, your BSA AML compliance markets. People need to be involved in that decision because they still have to file currency transaction reports. Don't do what an institution I worked at did and who didn't involve me, and then we had to file $5 million worth of back filing CTRs, which I don't know if you've ever had to do that before, but I'd never wish that on my worst enemy. It's very painful. And you don't want to have those conversations with your regulators. So some final thoughts here before we go into Q&A briefly. Achieving Treasury management goals requires creativity and thinking outside of the box. A successful program at an institution takes commitment and takes multiple line of businesses being involved. Emerging markets offer a high volume of high value potential customers, and you've got to be able to understand that there's not worth getting in these emerging markets if you're only going to make 5 or 10 customers. The risk is not worth, there's not much reward there for the risk, right? So if that said, if you need to be able to have a scalable program, and a scalable program is not a manual program. So take that into consideration when you're thinking through this. What are my technology needs I'm going to need in place? Anything else to add, Dina?
I think no. You summed it up very well. Maybe we can see what question, if we have any questions.
Marnie?
We are out of time, and I think to be respectful of everybody else, we should probably say that as a reminder, all registrants will receive a link to the recording of the email. And then if people have any questions, they are welcome to email us at info@riskscout.com. We'd like to thank you for joining us today. Thanks to both Dina and Kristen for their great insights on treasury management and high-risk banking. And we hope that you'll join us on a future webinar. Thank you and enjoy the rest of your day.